Despite a lackluster first half of the year, analysts, they continue to have unusually high number of buy ratings on S&P 500 stocks. For more, let's toss it on over to Yahoo Finance's Alexandra Semenova and Jared Blikre at The Interactive. Guys,
that's right, Brad. Recession calls are permeating Wall Street. Corporate America is laying off workers, and the S&P 500 is in a bear market. You can take a look right here, down 20% year to date. But despite the downbeat outlook, analysts appear to be more confident about the companies they cover than ever. According to data from FactSet, stocks in the S&P 500 continue to have an unusually high number of buy ratings, more than 10,000 analyst ratings on companies in the index. 57% of those ratings represent at least a buy rating. The last time the share was at this level was in 2011. Let's take a look at the sectors right over here.
2011, that was 11 years ago. I'm stating the obvious, and you don't have to assign any stories here. We brought our own. I think this is a compelling narrative here. These are some of the stocks that have the highest percentage buy ratings on Wall Street, and this is a market cap view. So you're going to see Microsoft and Alphabet are the big kahunas here. Guess what? Meta used to be there. Amazon used to be there. All the big names, the mega caps used to be there. But these are the two generals that really haven't fallen just yet, perhaps, at least in Wall Street's eyes.
Yeah, really interesting. And FactSet conducted the same research in February, and we had more of those mega cap names with buy ratings higher up on the list. So the only ones that are still here are Microsoft and Google. And another interesting one that I want to point out is T-Mobile. You can see doing quite well compared to the other companies. If you look at it year to date, you can see it's back up from that low in January.
This was about 30% increase, even though it's only 15%, but it did bottom earlier in this year after the new year.
Yeah, let's also take a look at the companies with the lowest share of buy ratings.
Right there, we got that. So, boom.
So obviously,
a couple of green names here.
Yeah, the standouts here are Progressive and Con Edison. Let's take a look at Progressive. Also seeing a nice rebound.
Yeah, and a finance company at that, basically geared by a higher yield curve, and that benefits some of those names as well. And we have a utility, Consolidated Edison. Ooh, yeah. I pay them money every single month, so I'm glad they're up year to date as well. That price inflation in terms of energy costs helping this stock.
Also seeing more than 20% rebound from that low earlier this year.
Any other names here? Let's take a look at Clorox, because this is down 25%. This is a consumer staple. Let's put a 3-year chart here, because guess what? This was an early riser because of the pandemic boom, but you can see it's round-tripped those gains and is now down 16% over that time frame.
So the lesson, I guess, is I don't know, don't listen to analysts?
The thing is, I see it as kind of random right now. Wall Street is over, all the hype on Wall Street that we had during the pandemic has yet to fall off. So I think there needs to be a catch down to reality. At the end of the day, we're going to have a massive re-rating cycle to the downside, but we just haven't seen it yet.
Yeah, it appears analysts are now playing catch up on revising those ratings. You could see that with some of the bigger names.
A little late maybe. All right, thanks guys, really appreciate it.